What is base rate? The base rate is the interest rate set by a country's central bank, below which commercial banks and other financial institutions are not allowed to lend to customers. It serves as a benchmark for all other lending rates, impacting the interest rates that banks offer on loans to their clients. Base rates vary across countries, as each central bank determines its own. Commercial banks are required to adhere to this rate, ensuring that they don't lend at rates lower than what the central bank stipulates. The central bank sets the base rate to improve transparency in the credit market and ensure that banks lend to customers at affordable costs. Loan pricing is influenced by the base rate, and the distribution of loans is guided by the associated credit risk premium. The base rate should not be confused with the bank rate. The bank rate is the rate the central bank charges commercial banks for borrowing funds. Any change in the bank rate directly influences the interest rates set by commercial banks. If the central bank raises or lowers the bank rate, commercial banks must adjust their interest rates accordingly. The central bank calculates the base rate, making sure it applies uniformly to all banks within the country, whether public or private. Factors considered when determining the base rate include administrative costs, the cost of deposits, the previous year's profit and loss, and unallocated overhead costs. Of these, the cost of deposits is especially crucial in establishing the new benchmark. While banks can set their base rates within certain limits, they must always comply with the central bank's rules. Several factors determine the base rate, such as the cost of funds, operating expenses, the minimum rate of return expected by investors, and the cost of maintaining the cash reserve ratio as mandated by the central bank. Base rates are closely linked to a country's monetary policy, which is implemented by the government to maintain economic stability. Central banks control interest rates and manage money supply in the economy as part of this policy. The base rate is a vital tool in regulating money supply and demand. When there is excessive money in the market, demand increases, leading to inflation. To curb inflation, central banks raise the base rate, tightening the money supply. Various factors affect the base rate, including the demand and supply of money, fiscal deficits, government borrowing, inflation, and central bank policies. When demand for money is high, whether from companies for investments or individuals for personal loans, interest rates rise. Conversely, when there is an excess supply of money in the economy, base rates tend to decrease. Government borrowing also influences base rates, as governments are often the largest borrowers in the economy. Inflation, which leads to rising prices of goods and services, is controlled by adjusting the base rate to ensure that the purchasing power of individuals is managed effectively. Lastly, central banks adjust base rates according to the overall economic conditions, particularly focusing on inflation during periods of economic growth.